And now, 41 NBC's Business Spotlight. In the spotlight today, Bennett Financial.
Your home may be your biggest single asset that you have. So when it comes time to selling your primary residence, you may be asking, what will be the effect on my taxes? Today we're going to look at one area of the law that allows you to legally exclude your profit when you're selling your primary residence. Now, to determine if you qualify for the home sale exclusion, we look at three criteria: ownership, how the property has been used, and the timing of the sale. Now, for the ownership criteria, you must have owned the home for at least 24 months. And if you've owned it and lived in the home for the 2 out of the last 5 years before the sale, then you will have met the ownership test. Now, to meet the use criteria, the home must have been your primary residence for 2 out of the last 5 years of ownership, preceding the date of the sale. Now, the timing criteria only allows you to exclude the sale of a primary residence once every 2 years. So if you meet all three of these criteria, then you will be eligible to exclude up to $250,000 of profit from the taxable income. And for those of you filing a married joint tax return, the exclusion doubles up to $500,000. Now, while the law allows you to exclude your gain from your taxable income, if you sold the home at a loss, you are not allowed to take a deduction for the loss. Now, if your profit exceeds $250,000 and $500,000 limit, then the excess would be reported as a capital gain on Schedule D of your tax return. Now, if you do not meet all the requirements discussed today, there are other special circumstances that may allow you to claim a full or even partial exclusion. So please give me a call here at Bennett Financial if you have any questions or you're getting ready to sell your primary residence, and I'll be glad to assist you in that. Now, thank you for joining us this week in the Business Spotlight, and we look forward to seeing you next week.